Good afternoon, ladies and gentlemen. It is April 8th of 2020. I am joined as usual by our associate here, Tim Devlin. Tim, how are you doing today?
I'm doing well. How about yourself, Rob?
Oh, we're doing better than the last few weeks as we've got a bit of a recovery playing out here, which we're going to talk about today. But ladies and gentlemen, I want to welcome everyone from across the U.S. that is tuning in to this week's market update. And really what we're going to focus on this week in particular is that budding recovery that we see amongst a lot of those secular growth stocks that we focus on as a firm, because we're paying attention to the 2, 3, 5 year plus picture, not the 1 month picture. And that's something we've really talked about as we went through that correction in late February and early and mid-March, even the latter part of March. And so we just want to go through all of that today, provide a little bit of a synopsis and some of the trading conditions that are taking place right now. But let's go ahead. I'm going to go ahead and share my screen here. And, one of the big themes, ladies and gentlemen, is that as this reopen noise begins to get priced into the market, or not so much beginning to, but continues to get priced into the market, we're starting to see the surprise of it, the shock of it taper off. And as that happens, what investors start to look at is, what are the prospects for these businesses aside from the fact that they're going to survive? When a business goes from likely bankruptcy to survival, it is justified. The stocks will go up justifiably, without a doubt, because you're pricing in a potential zero to survivability. But to have a long-term growth path for that stock price, there needs to be a long-term road to profitability and sustainability. And that's really where we think a lot of these stocks are going to enter into some headwinds today, tomorrow, and over the coming months. And we're already seeing signs that money is beginning to rotate back into what we call long-term, durable, high-quality growth, which is really where we focus on. So today, a couple of the key messages that I think, and that Tim as well, I think are key takeaways, are that secular growth stocks, so a lot of the companies that we are positioned in as a firm, successfully retested the lows from mid-March, like we discussed, right? You get the initial bang of the sell-off, right? You get a head fake rally, a retest of the lows. So we need to retest that selling pressure, and then we finally get the breakout. We are seeing signs of that. We're seeing those signs of a lot of individual stocks breaking out over the last 5 to 7 trading sessions, so that are across the board attempting those breakouts. Secondly, record inflows are chasing these junk stocks, these economically sensitive cyclical stocks that were at the center of the COVID storm. We're seeing record inflows, especially on the retail side. When you see that, those big spikes in inflows, you want to go the other way. Because if you go with the crowd on that, that is usually where you get burned. And something that we spend as a team, as a firm, a lot of time on trying to coach clients, because we always hear this aspect of the stock market is rigged. And it's not really rigged. What is rigged is the way we think as human beings. We like to see that other people agree with us, right? That's why we live in societies, in towns, in cities, and countries. We like the idea of conformity, even though we say we don't. And so for investing, we need to stand alone. We need to be alone. We need to be the first there and let the crowd follow us toward those spots that we're already positioned in. So that's really what we're going to go over on the inflow part. And then the third big thing today is that volatility is reverting back to pre-2020 conditions. We had the regime of 2016 to 2019, really in that range of 10 to 20 on the volatility curve, on the volatility scale. We then got into this COVID volatility era where we were in that 20 to 35 range, which is not good for long-term sustainable returns. The good news is we're going back to pre-COVID levels. And Tim, what were the types of stocks that led in 2017, 2018, and 2019?
Yeah, it's those long-term secular growth names like you're talking about.
Exactly.
Um,
And yeah, go ahead.
you know,
Sorry.
I think it's interesting because when you talk about the record inflows chasing junk stocks, one of the things we often talk about is you want to skate to where the puck is going. You don't want to chase it. And I think over the past month or a couple months, especially, we've seen people chase it, especially with, the rising introduction of retail trading. You're
For
seeing
sure.
that just on your day-to-day conversations, right? And so I think that's really a lot of what we talk about is just coaching back to where is it going? Where is it heading? You don't want to be chasing those names.
Absolutely, Tim. And, if you were positioned in a lot of those cyclical stocks back in, call it July, August, September, October, November, then great, you made a great trade. But if you're buying them now, I got news, ladies and gentlemen, it's long in the tooth. And there are areas within that reopen that are the real deal. And, we're positioned in some of those names. But some of the stuff like the airlines or stuff that's like very cyclical, boom bust in nature, I think we need to be really careful at this point. And we're going to go over why here in a few minutes. But real quick here, ladies and gentlemen, vaccines are working. Wanted to provide a quick update here in terms of what's going on with COVID. We've got some questions that came in this week about the uptick in cases in the US, the uptick in cases, especially in Brazil, Chile, and then overseas in Europe, in France in particular, and even in Germany. And the reality is the vaccination rates are so much lower in those countries. And what's happening in the US is a miracle. We talked to, if you remember back in February, that US is a country with a history of it's hard for the country to get going on something, but once it does, it's like an unstoppable train. And we saw that with vaccinations, a kind of a sloppy start in the November and December there. Well, once the momentum started to go, sort of similar to the way the US was with its industrial pickup in World War II, once a train left the station, there was no stopping America. And what we see here is that's playing out in the hospitalization rate, down 71.5%, even though cases have slightly ticked upward over the last 2 weeks. That daily mortality rate down 81.7%. And then the moving average of new cases continues to plummet. So the bottom line message here, ladies and gentlemen, as someone that got vaccinated myself, it's working. So if not to get off topic here, but if you have that chance to get a vaccination, we definitely encourage that. We're not doctors by any means, but we just pay attention to the data, and it's what's great for the country. Let's reopen this thing and get back to normality, because that's really what the best thing that can happen for the market and for best of breed businesses that we're invested in.
And what you're seeing as well is, those groups of people able to be vaccinated is widening too. So while you're seeing that data, like you talked about, just looking forward to the amount of people that are going to be able to receive vaccines is also going to be increasing.
Well, for sure. And I'll add a little anecdote there, Tim. Like, I'm certainly not 50 and above, and neither are you. And when I scheduled my vaccination back on was it Tuesday, I think, there was like 100 open slots. And so I got my wife booked, and, I got a lot of friends of mine that are getting vaccinated, people here around the office that are under the age of 50. So the message here is the slots are available there for people. And, it's just going to be good for the economy, good for the market. And if we're positioned in great businesses, it's good for our pocketbooks. So just a different way to sort of think about the vaccination approach. Now, real quick here, ladies and gentlemen, we've made a lot of progress. Still down about 3.8% year to date, but well off those double-digit lows that we saw a couple weeks back. And in particular, as you know, we always pay attention to the 1-year number, because when we invest in a business, we're looking for those 12 to 24-month trajectories in terms of investment returns. We are up 118.05% versus 48.36% for the S&P 500, giving us about a 70% rate of outperformance versus the S&P 500 after fees. Since inception, we are up 215.08% versus 82.24% for the S&P 500, generating 132% points of outperformance versus the S&P 500, again, after fees. So the message here is just quite simple, is that over time, great businesses rise to the surface, and short-term noise is just that, short-term noise. Put the blinders on, focus on quality, focus on secular growth, and over the long term, you should be able to make money. Now, one thing we want to do this week was talk about some of these shorter term trade conditions, because they certainly dominate the media. Now, the center of the correction was really in the NASDAQ. The S&P 500 was, for the most part, not impacted that much. I think really 4-5% at most during the nadir of the correction. But here with the NASDAQ, what we see is, we talked about this initial low. When we get corrections, whether it's market-wide or a specific area of the market, it starts off with a bang, right? Lots of noise, lots of volume, people panicking, get me out, get me out, get me out today. And you see this violent swoosh lower until you establish a low. It's called an anchor low. Once you get that, you get sort of a counter trend rally, which is what we saw there in the second week of March. Then, in order to really get out of the correction, you need to retest the lows. You need to test the seller's resolve. How much inventory of stock is out there to continue selling? Once you establish that retest, successfully retest, so in other words, we don't break the prior lows and start to move upward, that is usually a sign that we're getting out of this correction. And that's what happened. If you remember, we've talked about this week in, week out through this correction process, that we need to see that retest. We saw the retest last week or a week and a half ago, and then we started to move higher. And that's exactly what we're seeing. This retest was on low volume, which indicates to us that we're starting to clean up the supply of stock out there. So a very healthy short-term trading condition, something we always look for, back on, back in our hedge fund days there. So, really trying to clean up that supply. Last thing here real quick, April is a seasonally positive month for stocks in general, not just growth or value, just in general, a great month to be invested in the market. Now, with all that said, the S&P 500 itself is a little bit overbought. Now, you may say, is that negative for the opportunity portfolio? And it's actually a positive, and here's why. What's driven this overbought condition has been that rush into cyclical boom bust types of businesses. Our area of the market that we're positioned in is not that overbought. In fact, it's recovering. So we're in recovery mode, while those areas of the market, which, believe it or not, about 60 to 70% of the S&P 500 are in that boom bust type of business model. So as the S&P 500 comes in, we actually expect that money to rotate back into reliable, high quality, secular, long-term growth leadership. There's a reason why it's leadership and secular growth. There's not very many companies that have those types of characteristics. So by its very math, they don't make up a large portion of the S&P 500. So overall, this is what we want to see right now, which will really allow us, if our research is correct, to really overtake the S&P for 2021 and continue our track record of secular leadership. We talked about the VIX, that regime change that's taking place, ladies and gentlemen. Before COVID, the VIX is just a measure of demand for puts versus calls, and the premium that we want to pay for portfolio protection versus, going really naked long calls and taking outsized risk on the long side. So when VIX goes up, there's a lot of demand for portfolio insurance. Not a good thing. You don't want to see that go up. But when it goes down, it's a indication that things are getting better. Now, typically, this VIX chart has ranged from 10 to 17, 18 or so, maybe 20 on the higher end. And then if you spiked above it, that was during crisis or, during some sort of market panic, whether it's short-term or long-term. During COVID, we got a new structure, which was from 20 to 30, which is not a healthy condition. It's a symptom of, what happened? The pandemic, COVID, global financial crisis back in 08, 09. And so for the last year, we've been in this higher range. For the first time, we're now breaking back into this range. So when people are saying, hey, the VIX is at its lowest levels in the last year, and oh, that's a sign of danger, please ignore that, ladies and gentlemen, because the reality is we're actually at the upper end of the prior more normal range of really 2010 to 2017, or sorry, 2019. This is a healthy thing. So as we go from 17 back toward 14 and 15, if that does play out, that should in general be good for stocks. And the types of stocks that dominate in this era, secular long-term growth. Very important point to pay attention to. Another thing we do here at LifePro is we also pay attention to the riskiest, not the riskiest, but the most volatile areas of the market. And certainly cryptocurrencies are very volatile. And we have a very tiny, about a 2.5% position in Ethereum. And, you know, for us, that is an area of tremendous long-term growth. We're talking like our picture here is over the next 10, 15 years. And we really think this is going to be an area that really dominates the financial sector over the next 15 years and can really disrupt the financial transaction business across the globe. That being said, it's volatile. And so when any asset class has a lot of volatility, what we like to pay attention to is how is it behaving relative to the broader stock market? Because sometimes it can give us leading indicators or leading indications of risk appetite. So notice what happened here with Ethereum. We had a good idea that the NASDAQ was about the bottom because cryptocurrencies, both Bitcoin, Ethereum, Cardano, a lot of these, even Chainlink, a lot of these crypto tokens started at the bottom at the end of February, about 2 weeks ahead of when the NASDAQ bottomed. Then we got a retest again 2 weeks ahead of the retest in the NASDAQ. And then finally a breakout from a very bullish cup and handle formation, something we, you know, on the trading side, we really like to see. Cup and handles are very, very bullish. You want to see that. Broke above this prior resistance. This was huge resistance before the sell-off to higher highs. That's bullish. This is stuff that we like to see. Now, on the economic side, you know, we always like to pay attention, make sure the economy is healthy, and certainly with all the stimulus and monetary support that we've seen here, US manufacturing activity has exploded to the upside. And you've seen that play out with these cyclical junk stocks, these economically sensitive stocks. But believe it or not, ladies and gentlemen, what happens, you know, when, you know, Tim, maybe actually I'll play this to you. I'll play as a question to you. You know, what happens when we get above 60, right? When we get to the upper end of that manufacturing activity range as it relates to economically sensitive stocks?
Yeah, when we look at it, you know, at some point it has to normalize, right? That rate of change at the beginning is very fast, like we see with lots of things to talk about, but it can only go so far, so fast, and we have to see it kind of normalize out. And we see that around that 60 level, like you're talking about.
Yeah, and so it's called rate of change, second derivative, ladies and gentlemen, and that is we don't always want to pay attention to the notional indicator. We want to pay attention to rate of change. Is the rate of change accelerating or decelerating? Now, what we did is we took all these global ISMs and we focused strictly here on the US on the right-hand side. So since 1980, the 50, anything above 50 means manufacturing is in expansion mode. Anything below 50 is recessionary mode. When you get above 60, you have very few observations where activity levels are that high. In other words, it's like if you go for a 10-mile run and you sprint for the first mile, at some point you just can't keep it up. You got to slow down. You got to pace yourselves before you reaccelerate. Right now we're above 65. It's just not sustainable. I mean, if you look across history, only one other observation where we briefly hit 70 in the mid 80s. So at some point, we're going to decelerate. And as we decelerate, that money flow will rotate out of those economically sensitive stocks because they're pricing all this activity in. And again, back to the more stable long-term growth that we were talking about. But the good news here is that that's not bad that it's decelerating. It creates a more sustainable long-term economic picture. And across the globe, what we see is a recovery, a global recovery. The only exception really Brazil, India, and increasingly China, something we need to pay attention to, but Brazil really suffering from those COVID outbreaks. So again, aside from Brazil, Latin America in general, we really see a strong global recovery right now. But again, deceleration, and we see that. Remember, we talked, this is a chart we brought up about a month ago. We said, hey, inflation is now dominating the news story. We see all the indications of inflation, and boom, just explodes higher in the newspaper. Believe it or not, ladies and gentlemen, that was actually near the bottom of our strategies returns, the bottom of the NASDAQ, the bottom of the S&P 500. The next month was about retesting those levels, which was volatile and nerve-wracking, but we never broke those levels. And sure enough, it was right when all those headlines came out about inflation. Once you see it on the front page, ladies and gentlemen, it's in the stock price. We know about it. It's not new news. In fact, what you're actually probably going to see here over the next 2 months is inflation go up. And it would not surprise me to see treasury yields come down because the market prices these events ahead of time. It's called buy the rumor, sell the news, or sell the rumor, buy the news. It's already priced in. We know it's just a mathematical quirk where we're going over those very low levels from a year ago. So inflation is going to appear high, and then it starts to resolve itself lower. And then, Tim and I were talking about this earlier, just about an hour ago. So, and Tim, what do you take away when you see this chart here? When you see this huge amount of retail money chasing the reopen trade?
Yeah, I mean, if we look at the chart on the left and the chart on the right, you see huge spikes. And if you look at past historical instances, after those big spikes, we see it reverse, we see it revert. And that's kind of what we talked about earlier is, you don't want to chase these big moves because they will revert at some point.
Absolutely. So the summarize, ladies and gentlemen, huge spikes in retail speculative flows. Get on the other side, right? Okay, the trade is played out. Let's move to the other side. And we see that playing across not just the wider market, but also the specific cyclical sector ETF flows. So what are those cyclical sector ETF flows? The financials, energy, industrials. Look at these spikes, ladies and gentlemen. It's consistent across the board. So when the evidence lines up, we need to pay attention and be mindful and not be afraid to lean against the consensus. That's important. That's how we build wealth. That's how we make money. And that's how we stand different than the rest of the crowd. And then, of course, this is a chart, again, we used a couple of weeks ago, was with that normalization, right? These reopened stocks, believe it or not, have topped out for the last 2 or 3 weeks. They have not been making new highs. And that's, again, because they're trading back to levels they were before COVID smacked us in the face a year ago. And so at this point, when you're buying these stocks, you're buying them not because they're going from bankruptcy to reopen and survivability, but you're buying them based on what did you really think this business was going to do in December of 2019. So again, remember, if you're buying a cyclical stock, you're buying a reopen stock, you're really buying that business in December of 2019, and its likely growth path after that point if COVID didn't exist. Now, if you like that business back then, it's probably still a decent business to buy, but something to be mindful of as we go forward. And again, as we say every single week, ladies and gentlemen, we're always going to be, when it comes to secular growth and fantastic businesses, even businesses we don't own like Amazon or Tesla, Apple, Facebook, Netflix, Google. These are businesses that are constantly in a state of optimism overshoots or excessive pessimism. Very rarely does a stock trade at its fair value. And so what we have to say is, as long as over the long term, we expect that dotted line of intrinsic value to continue building upward and to the right at an accelerating rate, we want to own, not trade businesses. Very important point, ladies and gentlemen. We own, we don't trade stocks. That's how you make money. That's how you build wealth. all of us have those friends. Hey, I flipped this stock 2 weeks ago, and then I flipped it this week for a gain, and yet they still, they don't enjoy lifestyles that are that much different than all of us. So if they're doing something that's so great, always look at their lifestyle and say, well, why do they still have a day job? And so the important point here, ladies and gentlemen, is the wealthiest people on the planet invest and own businesses. They don't try to day trade and create value that way. There's a reason why, if you look at the top 500 wealthiest people on the planet, they all kind of do the same thing. So why don't we try to do what they're doing versus the opposite of what they're doing? And that's how we've created that performance track record over the last few years. So overall, ladies and gentlemen, junk stocks are really starting to lose steam here. We need to be careful. We are very, very cautious in that area. And as that happens, we expect that money flow to return back to companies with attractive long-term growth prospects. So in other words, those junk stocks are very, very, very overbought. Bonds, believe it or not, actually somewhat oversold. The second derivative of economic growth is likely to ease to feed that money flow back into secular growth. So those are the areas that we want to stay focused on. So on behalf of Tim, myself, the rest of the team here, we just want to thank everyone for tuning in. As usual, if you have any questions or concerns, please reach out to your advisor, reach out to us. We're here to help. Your advisor's there to help. And we're just so incredibly appreciative of your business and your patience through what was a rough March. But as you can see, once we start to recover, it starts to recover pretty fast. And over the next year, we're going to stay focused on what we're good at, and we're going to stay focused on secular growth, and the companies leading the charge with solid long-term growth prospects, healthy balance sheets, and clean, transparent, and easy to understand business models. So thank you again. Have a fantastic week and have a great, great evening.